Hello, everyone. Thank you for inviting me here. I'm really honored. I hope I'm audible. This is my first time using this mic. Yeah, thank you so much. So I was told to talk about Gen Z. I hardly see anyone from Gen Z here. So thankfully, ma'am had a brief speech and gave me 5 minutes to rewire my speech. And as YouTubers, that's usually enough. So I have an alternate speech prepared also. I'll start with the basics I really wanted to talk, say 5 minutes on Gen Z, and then I'll move on to other things I really wanted to discuss. But I'm sure there are Gen Z family members or some Gen Z people sitting here. There's one major problem I see with them, and it's not their fault. Probably it's our fault, but one major fault. Indians were traditionally known to be savers, and we took debt either when our business demanded it or for education or loan. But we never took debt for discretionary, consumable assets. We were not comfortable with it. Our savings rate was always very healthy. And recently I saw in the last 3-4 years, young people, first job, the first thing they'll do is buy an iPhone on EMI. And I did not know the root cause behind it. What's creating this behavioral change? And last month, I realized what's causing it. So I went to purchase a car. My brother-in-law is fond of driving, and we wanted an off-road vehicle. So we went into the Nexa showroom to buy a Jimny. And they told us there's 1.5 lakh rupees of incremental additional discount if you took it through the finance route. And I was taken aback. I thought I'll just give a check and buy the car. And we thought, okay, 1.5 lakhs of discount is not bad. What's the minimum finance I can take? They told 1 lakh rupees. And it will be over in a year. The EMI will be 9,000, but you get flat, 1.5 lakh off. And the finance brain in me, it's telling me, it's practical, it's rational. Please do it, do it. And then next day, the guy comes, wants me to sign some pledge papers, give him a couple of blank checks and things like that, and I freaked out. I was scared. And I told him, and I know, as a person from a financial background, it sounds insane, but I told, nahi, mujhe nahi chahiye. I'll pay it up front. And probably because, my background, my family has always lived paycheck to paycheck, and that's sort of hardwired, and it was an emotional decision, not a rational one. But I thought, no, I don't want to take it. And I'll also tell you why I partly think it was also a financial decision. Because if I purely look at it from an Excel calculation point of view, I should have done that. But I also looked at it from a behavioral point of view, and I realized this is how I'll eventually get more and more comfortable with leverage. This is the beginning. The shivering that I'm experiencing now, I won't experience it the second time. And this is how probably Gen Z, before they realize it, are hardwired to take debt for their next purchase. And I think this is really dangerous because, at 25 years of age, less than that, sometimes more, you don't want to be trapped in this cycle of paying EMIs as soon as you get your salary. I understand if it's education, if it's home loan, I understand. But other kinds of debts, I think this is a really dangerous thing, and I think all of us, in fact, that incident made me realize that for the next few months, I need to focus my content more on this side because in general, I think on social media, we have sort of neglected that. Coming to the question that ma'am asked, how many of you have, started investing for your retirement planning? A lot of hands were raised. But the second part of the question, what corpus do you actually need? This sometimes gets tricky. There are complex calculators, Excel sheets, which sort of make it complex. I wanted to give you a small tip, a small thumb rule that you will never forget, and you can always do that calculation mentally, and you'll always know where do you stand. So we need to understand two concepts to determine the right retirement corpus. One is inflation, and a back of the envelope rule tells me inflation doubles every 11, 12 years. So if your retirement is 12 years down the line, you need to double whatever your expenses are currently. So if your monthly expenses today is 1 lakh rupee a month, 12 years down the line, you'll need 2 lakh rupees a month. If your retirement planning is 24 years, you'll need 4 lakhs. A basic back of the envelope calculation. So now you know one thing. You know what your expenses will be based on current expenses at the time you retire. I hope it's simple. I hope everyone now knows what their expenses will be after retirement. 12 years, your expenses will double every 12 years. The other rule is 4% rule. So the 4% rule says that your yearly expenses should not be more than 4% of your retirement corpus. And I'll give you the logic behind this 4% rule and why it's not 3 or 5. I'll repeat it again. Your yearly expense after retirement should not be 4% of your retirement corpus. So let me give you an example. If your monthly expense right now is 1 lakh rupee and there are 25 years remaining for your retirement, after 25 years, your monthly expense will be close to 4 lakh rupees. Of course, this is just all estimate. So 4 lakh rupees. Yearly expense, roughly 50 lakh rupees. So the rule says 50 lakh should be 4% of your retirement corpus. So again, a rough estimate tells me it needs to be close to 12 crores or 13 crore rupees. And why am I saying 4% rule? Why not 5? Why not 6? The simple reason behind that is inflation is 6%. So inflation will erode your capital 6% every year. 4% you are withdrawing every year. So basically your capital erodes by 10% every year, which is roughly the rate it will grow when you have invested it in hybrid instruments, mix of debt and equity. So it grows by 10% and it's eroded by 10%, so it roughly remains the same. So I hope all of you by now would have calculated their rough retirement corpus required. Of course, I would prefer a 20% margin of safety over that. So if it's 12 crore, I would prefer 15, 16 crores in this example. But that's roughly how you go about it. Of course, there are calculators you can use. Coming back to, and this is, I'll say it in the context of Gen Z because they are more sort of vulnerable to it, but I see all of us doing it. Whenever, and this is really, really important, whenever, and this specifically happens with retirement, that whenever we are falling behind on reaching our corpus for any goal, but specifically retirement, it happens most with retirement because it always looks as if isko bahut time hai. And therefore, there are other short-term, medium-term priorities, and somehow we keep redeeming money from our retirement corpus, which is why I believe the best retirement instrument, by the way, is NPS. We all often look down upon it, saying, we can't withdraw it before we are 55, 60, but that's why it's a great instrument. Otherwise, throughout our life, all our medium-term, short-term requirements, goals will take priority, and before we realize, we'll be at retirement. So first, NPS is really good. Second, and this is really important, whenever we are falling behind on our retirement goals, instead of pushing our retirement, if possible, by 2 years, or slightly, downgrading our monthly expenses, slightly downgrading our expenses, most of us, we start taking additional risk. We try to compensate discipline and time by taking additional risks. And that, trust me, can be really, really deadly. I understand as people mature, they realize it, but most of us never realize it completely. We always, in some ways or the other, start gambling to try and make up for lost time, lost discipline, or unplanned expenses. But we need to understand it only takes us behind. If you are falling behind on your retirement corpus, you could probably moonlight, you could probably teach, do something else, but you can't take incremental risk on your investments. Please understand this. the younger the investor is, the more they are also prone to recency bias because they are anchored to recent events. So for example, Gen Z, they've entered the market in the last 3-4 years post-COVID. And all they have seen is mutual funds going up, equity is doing great, IPOs doing brilliant, and so they are anchored to that performance. And I don't blame them for that. For them, that's de facto, that's how the market works. And therefore, they currently, I mean, because they've not seen the other way, how brutal the market can be, they've not seen 2007-8, they take unbelievably high risks. But while they are doing it, I find a lot of millennials, a lot of people from a generation before that also doing that because we all, to a lot of extent, are actually vulnerable to recency bias. You know, we weave these stories in our head that India is structurally changing, which it is, I agree. The next 20 years will be India's, which it will be, I agree. But that doesn't mean that there won't be drastic ups and downs. Drastic. And sometimes, in the long run, I agree, India will do great, but no one knows what happens in the short to medium term. We all know Sensex will be at 5 lakhs probably 20, 30 years down the line, but we don't know how many downs it'll see. And for someone who's post 50, we need to understand that majority of their cash flow was in the past. So if they take incremental risk now, they are in a much worse position than who's 25 because they won't have incremental income in the future for the next 10, 15 years to average out all the volatility. I don't care about a 25-year-old investing aggressively in an expensive market because at 25, 30, I know that for the next 10, 15, 20 years, his or her income will only grow, and if the market corrects, the person will always be in a position to average it out and lower the cost of acquisition. But not all of us are in that position. So if someone is above 50, they need to understand that you don't need to be swayed by this India story in the medium term at least. If you still have 15, 20 years to go, sure, bank on it. Also, the other part of it. There's a lot of debate going on every day on media, social media, and everywhere that market is expensive. And the running question always is, if the market is expensive, what to do? Should I redeem? Should I stay invested? Because the India story and things like that. And to me, it's simple. What you do is less relevant, but whether you understand the context and what happens when the market is expensive, whether you understand that or not. So the thing is, if a market is expensive, it can remain expensive. This happens with a lot of good stocks also. I've seen people who have been saying, including me, when I started investing, actually paper investing, not even real money, MRF was 10,000. And I got 1 crore of virtual cash on a platform, just gave money to try and track. And even then I did not invest thinking it's too expensive. I guess it was 13 years ago. Now it's close to 1,40,000. And it happens with the market, and it happens with a lot of great companies. They were expensive 20 years ago. They remain expensive they could remain expensive for the next 20 years. When we're talking broadly about the market and not specific stocks, we need to understand one thing. Expensive can remain expensive, therefore you don't time the market. But fundamentally we need to realize that when the market is expensive, it latches on to any smaller negative news to find an excuse to correct. And when the market is really cheap, it can ignore a dozen bad news and will latch on to the smallest of good news to rise further. So I don't know, and I don't think anyone knows where the market will go, how high will it go. I don't want to get into that. But fundamentally, we need, specifically if you're 50 plus, you need to keep this in our mind that if you need money for the next 2, 3, 4, 5 years, this logic could go wrong, market could double from here, but that's possible, not probable. And I always want you to play the game where the probability is in your favor and not based on possibilities. Another thing that I wanted to address, And I see a lot of people, and it pains me. And sort of, probably this is the reason that drew me to markets, that can I spread awareness on this? And surprisingly, it happens more with people who are closer to the financial circle, closer to finance, closer to stock market. They deal with financial stuff every day. I'm assuming people like you. I think it happens more. And this is the fact that you think because you have connections and you know people, any investment recommendation that you get will work better because it's an insider recommendation. Not the illegal types, but you just know more, or your contacts just know more, or you have better resources or network or acquaintances from the market, and therefore the information that you are getting is of higher quality than what the general public does. This is the bias that people who are closer to the financial markets have. And I see people paying a really, really heavy price for that. A really heavy price for that. So, one golden rule that I would request all of you to please follow is, do not assume that because you are in sometimes touch with fund managers, CEOs, PMS managers, investment advisors, you will get better access. Because I'm not saying those people will trick you. I'm not saying that. But what I'm saying is, to a CEO, his company is naturally the best investment opportunity he'll see. And he's not wrong in that. He's working day in and day out for that company. Naturally, if you talk to the CEO and ask how are the prospects of his company, he'll tell you the best possible scenario. And he's not fooling you. He also genuinely believes that. And the same thing happens with a fund manager. If the fund management team has analyzed a particular investment opportunity for a month, they have invested so much time and energy in that investment opportunity that they actually believe, because of their time invested, that it's the best investment opportunity. And when we take that opportunity over a networking dinner, I think that's a recipe for disaster. So it's important to understand that your network, your sources does not make you better aligned to get above average returns. I think 10, 11 minutes remain. I'll take a couple of minutes and then we can take some questions. One mindset thing I wanted to talk about here. We saw a clip where, young professionals talking about retiring at 35, 40, 45. And I don't blame it on them. There's no judgment. But I really feel that, it's sort of very contradictory to what I believe. So for example, I always say to my friends, family, that I'm currently 31 years of age. There are 69 years remaining in my life, and I want to work for the next 69 years. I love what I do, and I want to continue doing that. And I think there's no harm in, hoping to retire at 45, 50. But and it could be, and it's unscientific, I have no data for this, but I strongly believe in it, that continuing to work is really, really important for mental and physical health. I've seen it with my both sets of grandparents, my some distant relatives. I just feel that health quickly deteriorates if you don't work for a substantial period of time. I might be wrong, I've not read a paper on it, but I'm worried when people say they want to retire at 35, 40, 45, and with life expectancy right now, life expectancy in India is 73. By the time these 25, 30-year-old reach 60, India's life expectancy will be between 80 to 90 years of age. And when you retire at 40, 45, you are saying, for the next 40, 45 years of age, I'm worried. And I'll tell you why I believe in this. And I'd like to zoom out. This is a little philosophical, but I deeply believe in it. I think, we ultimately, money, job, career, family, everything is in search for more happiness. And this is a recent realization, and I keep changing my opinions quickly, so I'll say this is my current realization, that what is happiness? And I was looking for this answer for the last quite a few years. And recently, at least my current answer is, and I have conviction in this answer, that happiness is solving problems. No, we solve a puzzle, we feel happy. We repair a puncture in a tire, we feel happy. We repair a computer, we feel happy. Happiness is solving problems. And I think that's what work gives us. The other part, last 30 seconds and I'll then take questions. The other part, even if someone wants to retire at 45, good for him or her, probably it suits them and it doesn't suit me, so I don't understand. But if you want to retire at 40, 45, which a lot of Gen Z aspire to, then I don't see them making the kind of lifestyle compromise and adjustments that an early retirement would require them to. So the earlier you want to retire and the more you want to live on your passive income, the more compromises you would need to do in your active earning phase. So it's a delicate balance. I absolutely understand if someone chooses to retire between 50 to 65, I think that's a nice balance. But answering a question where you say, I want to retire at 35, 40, also tells me that you don't understand then that how much monthly investments you would need to do for the next 10 years to actually retire at 35, 40. One, you won't be able to do it. Most people can't do it. That will lead to sadness, sorrow, or if you actually end up being that disciplined, then you are actually compromising on your lifestyle and your family's lifestyle in your peak years. So I think it's a bit too aggressive. A nice balance would be around 50 in my opinion. We have 8 minutes remaining. If you have any questions, I'll be glad to answer.